All right, today we're going to talk about inflation. Okay, really boring. Now, a little bit of inflation is okay. Okay, a little bit of inflation is okay. Why is that? What is inflation? On average, prices throughout the entire economy are going up. Okay, on average. Not everything is going up. Some things are going down. But on average, most prices are rising over the course of time. Okay, and that's what inflation is. Throughout the economy, all prices on average are going up. A little bit of inflation is good. Why is that? Prices go up and costs remain the same, then there's a little bit more profit, right? So manufacturers want to increase their output because they're making more money. It stimulates the economy. Just a little bit of inflation. And we typically here in the United States, over the past 20, 30 years, not 20, 30, but past 20 years, I'd say, we've seen inflation rates running usually around 3% per year, 3 to 4%. That's all, not very much, okay? That doesn't impact us too much. But when inflation rates get up, way up there, when we get things like hyperinflation, okay, where you're seeing 10, 20, 30% per month, not per year, but per month, okay, then that's really bad. We don't want too much inflation because, as we know already, it destroys the purchasing power of our money. If we're earning the same amount of money, but the prices of goods go up, we can buy less goods with that same amount of money. Okay? So we want to keep inflation under control. Remember, there's two things we want the government to do. Keep inflation under control and keep employment rates very high, that most people have jobs that want them. Okay? Now, ain't nobody from Brazil, right? No? I used to go to Brazil in the 1980s for my job. Okay? Love Brazil. Rio de Janeiro, specifically. Gorgeous city, absolutely gorgeous. Okay? But Rio had a terrible problem with, Brazil had a terrible problem with inflation. Okay? 2,000% per year, right? Yeah, that's huge. That means anything that was $1 in the beginning of the year is $20 at the end of the year. Am I getting that right? Or is it 200? 200 maybe. Okay? Yeah, horrible, horrible. And they had a joke, right, that actually everybody's salaries were indexed to inflation, that every single month they automatically got a 10% increase in pay to keep pace with the prices that were going up like that. So, right? People would put their money in the bank overnight at really huge interest rates, okay? The bank was paying huge interest rates. What this does when you see high levels of inflation, it causes something called capital flight. Money begins to flow out of the country. Money that could be used internally for investment purposes goes to other places. Why? Because as your money is losing value, do you want to hold on to that money that's losing value every second? No, you want to get rid of it. So if you're in Brazil, you change your money into dollars or into euro or into yen, okay? So that it doesn't lose value. In fact, it may gain value, right? I mean, if you pay 1,000 a Brazilian currency and you get 100 euros, the next day you can cash that 100 euros in for 1,100 of the Brazilian currency, okay? If you want to. So a lot of people will put their money into foreign currencies. But if you're in Brazil and you've got euros, what can you do with euros in Brazil? Nothing. You have to invest it in a place like Europe. So money begins to flow out of these countries that have really high inflation rates, okay? So the country suffers twice because of high inflation. People's money is losing value all the time, and investment money is flowing out of the country to other places. Okay? They had such a problem in Brazil, okay? Let me see if I can. They used to call their money cruzeiros. Okay, cruzeiro, and inflation got so high that it took 100,000 cruzeiros to buy a cup of coffee. Okay, so what the central bank did said, bring in your 100,000 cruzeiro notes. Okay, we'll knock 3 zeros off them, and we'll give you 100 cruzados instead, okay? This is true, okay? And then after a year or two, the inflation was so high that again, now it took 100,000 cruzados to buy a cup of coffee. So they would do the same thing. They would say, okay, bring in your 100,000 cruzados, and we'll give you what are called new cruzeros. We'll give you 100 of them, okay? Not done yet, okay? A couple years later, inflation is so high that now it takes 100,000 new cruzeros to buy a cup of coffee. So what they did, come in and bring your 100,000 new Cruzero notes, and we'll give you 100 of these. We're going to call the money, it looks like real, but in Portuguese, in Brazilian Portuguese, it's pronounced real. Real. Real is money. It's just the name for their money, okay? And they had to do this 4 times because of inflation was so huge, okay? But that's not the worst. That's not the worst example by any means. In fact, they had a joke, as I started to tell you. If you went out to dinner, you had to pay for your meal in advance because by the time you were done with dinner, the price is up 10%. Zimbabwe. Okay, I don't know about last year, but the year before last, Zimbabwe, the inflation rate in Zimbabwe. Okay, anybody want to guess what it might be? What? 238 million%. Imagine that. What that means is that anything that was $1 at the beginning of the year, by the end of, oops, gotta get rid of that. By the end of the year was $2,380,000. Imagine that. A pack of bubble gum was $1 at the beginning of the year. At the end, it's $2,300,000. Now, what do you think happens to commercial activity when you get inflation rates like that?
You have to change your currency.
Yeah, you can't use currency. Becomes absolutely worthless. Nobody's willing to take currency in exchange for goods and services, are they? No. So what happens? We end up with what's called a barter economy, okay? People trade goods for goods because they're not losing value. In fact, they're gaining value. So money now no longer functions in the society. You have a much more inefficient system, trading goods for goods. And you know why it's so inefficient? Because barter requires what's called a double coincidence of wants, meaning for us to engage in a trade, not only do I have to have something you want, but you have to have something I want, or no trade, okay? When we have money on one side of the equation, there's always a double coincidence of wants. You got something I want, a good, and I have something you want, money, okay? But when money loses value, that system breaks down, and economic activity slows down, people's lives get worse off, everything takes place in barter, okay? It's all due to that criminal, Robert Mugabe, who runs the country. Does what?
Growing.
Growth? Sure. Economic growth? Certainly. Absolutely. It depends, actually, right? We know that as we're going to see, remember I said that we're going to translate this chart into a bigger chart. In fact, we're going to talk about that probably today. And instead of measuring quantity, we're going to measure GDP. And there's 2 ways for increases in GDP. We get increases in supply or increases in demand, right? Either case, it's going to grow GDP. And what will happen to the rate of inflation, the price level? No. Remember, it's going to be on your test today. Don't know. Right? Right? Both curves are shifting out. Okay? All right. Okay, so let's talk about inflation. How do we measure it? How do we know if inflation is taking place? I mean, the government, in order to know what to do with the economy, right, whether they should take actions to calm it down because prices are going up too fast, which is typically a feature of, prices can go up for 2 reasons, right? We can get inflation because of increases in demand. That pushes the price of a good up. And if this is typical of all goods, then all goods prices are going to go up, right? Or, how else can we get inflation? Decreases in supply, okay? As costs rise, supply curves shift in. And typically, what causes inflation of this kind? increases in things like oil prices in particular, okay? As the price of oil goes up, manufacturing becomes more expensive, supply curves shift in, prices rise, okay? So there's two reasons why we can get inflation, either because of increases in demand or decreases in supply, okay? But typically what we're looking at normally is increases in demand, okay? Increases in demand, but it may not be. Okay? Now, how can we measure that? How do we know if prices are going up? Well, the government goes out and they collect data. They say, what's the price of these goods now, and what were they before, right? So if something was $50 now, and it's $60 later, right? Then we've got a 20% increase in price, right? And the way to figure that out is you take the price today and divide it by the price in the earlier time. Okay? And then multiply 100 to give us a rate. Okay? So we've got 60 over 50 equals what? 1.2, okay, multiplied by 100. And now prices today are 120%, right, of prices in that earlier time, okay? What percent of prices are prices in that earlier time? If I said, what percent of, let's make this, this is 2013, we'll make this 2012, okay? What percentage of 2012 prices are 2012 prices? 100%. In order to, the price today, if today is 2012, price today divided by price today, okay, equals 1 times 100 equals 100%. Okay with that? 2012 prices are 100% of 2012 prices, correct? All right. 2013 prices are 100 plus 20% more, 120% of 2012 prices, okay? Now, the reason why I did that is we're going to measure inflation rates by using an index, okay? An index is just a measure of the rate of change over time. But our index is really just a percentage change thing. And the only thing we do to make it an index is we drop off the percentage sign. That's all, okay? So if we create a price index for 2013 based on 2012 prices, the price index, the measurement of inflation for this year is going to be 120, okay? Prices this year are 120%. Just think of it as percent. Okay with that? All right? So this is going to be our measure of inflation. Now, as we can see, prices are 120% of 2012 prices. Okay? What year we base our index on is arbitrary. I mean, it can be last year, it can be 5 years ago, it can be last month, it can be 6 months ago, it can be 10 years ago, it can be 100 years ago. Okay? Whatever period we are basing our price index on, okay, that is our base period. And let's say, just for the sake of example, oops, put that in. Come on, am I already on 2? Nope. Why isn't this doing anything? Is that it? Do I have to put everything down? Huh, no, don't know. Oh well, we'll just add another one. No, I'm not going to add another one. Why is this thing stuck? Use the what? Huh, that won't work either now. What happened?
Click on the marker upstairs.
No. Which one up here?
The marker?
Which one's the marker?
I think it's frozen.
Yeah, you think it's frozen? Yeah, it looks like it. It's not doing anything. Huh. Close it? Won't even close. Huh. Frozen. I broke it. says it's running. Is it running now? There we go. All right, just frozen for a minute, okay? So as I was saying, what year we compare ourselves to, okay? That's our base year. And remember what I said, that if we say that the price index, the index, is equal to price today divided by price in some time, don't know when, times 100, okay? If we're talking about 2013 and 2013, and let's say the good is $50 today, and it's $50 today, right? So what's our index going to be for the base year? 100. It's always 100, okay? Base year prices are always 100% of base year prices. They can't be anything else. If we try to find the index by using base year prices, we end up with an index of 100, okay? So we can always tell the base period, what period we're comparing ourselves to, because that period has an index, an inflation of index of 100, meaning 100% of base year prices are base year prices, all right? Or the base year prices divided by base year prices are 100%, correct? All right with that? Okay. And then we add the rate of inflation. So if, let's say, the base year is 2012, okay? So the index for that year is going to be 100. Think of it as percent. Base year prices are 100% of base year prices. Now, by what percent did prices increase in 2013? And let's say that they went up by 50%, okay? That anything that used to be $1 is now $1.50, all right? What's the index going to be for this year? 100% base year price plus the 50% increase, 150. Okay with that? All right? Okay. So think of these as percentages. Do you know any indexes? We talked other than indexes of inflation, like we know the consumer price index, computer. We didn't talk about those things yet at all, did we? All right, we'll talk about them. The index that we're probably most familiar with, the Dow Jones stock index, okay? The stock index, all right? What's the stock index at today, do you know? Actually, it's much higher than that. It's about 15,000 plus. Okay. What did the index start at? What was the base? What was the index for the base year? 100. Yeah, 100. Do you know what year that was? 1893, I think. Okay. So what does that mean? Prices of stocks, on average, have gone up by 150 times. Okay. Or 15,000%, right? Is that right? Okay. But that they started at 100. So the base year is always 100. Okay. So if we want to find, so what the government does is it goes out and it checks on the prices of what they call a basket full of goods, a bunch of goods, okay? And they compare the prices of those goods today with the prices of those goods in the earlier time. And then they measure how much inflation, how much prices have gone up, okay? So if you went out in, let's say, 2000, and you measured, and you took the prices of a bunch of different goods. Now, I used to, when I worked for one company, AGFA, CompuGraphic, every 3 months I would get a letter from the government saying, for this particular model machine, okay, you told us the price 3 months ago was this. What's the price today? And I would write it in and I'd mail it back to them. This is how they keep track of prices. They also go into the supermarkets, right? And they put prices in. Sometimes the people that you see walking around in the supermarket with these handheld things, sometimes they work for that supermarket, sometimes they work for the competition, but sometimes it's the government coming in collecting data, okay? So that they can compare prices today versus prices in some earlier time and see how much prices have gone up. So let's say in the year 2000, we looked at a basket full of goods. And the price of those goods was $1,500. And then we did it again in the year 2010. And this time, the prices of these goods were $1,650. So we want to know in the 10 years how much inflation took place. Okay? So what do? It's the price today of a basket of goods divided by price in the base period, whatever that is. Okay, and multiply by 100. So we have 1,600, assuming that's today, all right, 1,650 divided by 1,500, okay? And what does that equal? 1.1. Okay? If we multiply it by 100, the index today is 110. The base year index for 2000, always 100. The index for this year, 110. What does that mean? Prices this year are 110% of year 2000 prices. Okay, the prices have gone up by 10% between 2000 and 2010. Okay? So, government goes out, collects data, and then publishes estimates of the rate of inflation in the economy, okay? And that way they figure out whether prices are going up rapidly and they need to take action to calm the economy down, or, by the way, the opposite of inflation, deflation. Okay. We haven't seen any deflation in my lifetime. We came close last year, or the year before, but I've no experience with prices actually on average going down. It's going up. There's a whole other set of terrible problems that occur when prices go down, when we get deflation, okay? I'm not really sure what they are, but I know that there are. All right? So we measure the rate of inflation. There are 3 price indices that I care about. The other one I don't really care about, okay? We have the Consumer Price Index. The Consumer Price Index is a narrow measurement of inflation, okay? It only looks at what people who live and work in the city are paying for goods and services, okay? So it doesn't care about me out in Lunenburg. Consumer Price Index doesn't involve me. It only involves you people if you live here in the Boston area or in the urban area, okay? And it doesn't look at all goods. There's lots of problems with the Consumer Price Index, okay? It doesn't take into consideration changes in quality or advanced features. Just says, this is a TV now, that was a TV then, okay? Doesn't matter that it's 3D now, right? HD. I have a 3D TV. Useless. Really? There's hardly anything on TV that's 3D. Plus, it hurts my eyes to watch. Yeah, I spent a ton of money on it and it just sits in my spare room unused. Oh well. Okay, so and it doesn't attempt to capture changes in prices of all goods, and it only looks at people living in the city. So it's a fairly narrow measurement. It's used as a standard by which some things are measured, like payments out to people, like Social Security payments or cost of living allowances. I think for some people get indexed to the rate of inflation, right? As inflation rises, so does your payment, and that's typically related to the Consumer Price Index, okay? The CPI is also called the Cost of Living Index because it is a fairly reasonably accurate measurement of what it's cost to live in the city, and which encompasses most people, right? About 80% of the population, I think, 70% of the population lives in the cities or in urban areas, and only about 30% out in the country. Hardly anybody is on a farm now. Right? By the way, I read, you know what China is doing? China is relocating people from the country into the city. Okay? They are forcing people to move out of the country and into urban areas in an attempt to stimulate the economy. How many people are they trying to move? 250 million, which is like trying to move almost the population of the United States. Imagine that? That's amazing, right? Good luck to them. Anyway, All right, so we have the consumer price index. We also have what's called the producer price index, which measures prices of what manufacturers are charging, okay? Now, typically, we don't buy from manufacturers, right? We buy from middlemen, distributors, Best Buy, a Stop and Shop, or whatever, okay? So if manufacturers, their prices are going up, what does that mean for us? Our prices are going to go up also in the future, okay? That if manufacturing costs and prices are rising today, what's happening to supply curves if costs are rising? They're shifting in, and what's happening to prices? Going up, okay? Does that affect us today if manufacturers are paying higher costs today? No, but it will affect us in the future, right, okay? So one useful thing about the producer price index is that it's a warning to us of inflation to come, okay? That if costs are rising, if manufacturers' prices are going up, we're going to pay higher prices in the future, so better go out and buy it now, right? Go out and buy that car now. Okay. Now, these are both fairly narrow measurements. They don't attempt to capture changes in prices of all goods and services. We have a different measurement for that, okay? The broadest measurement of inflation that attempts to capture changes in prices of all goods throughout the entire economy is called the GDP deflator, okay? Now, there's two pieces to this GDP deflator, okay? GDP, what's GDP? Gross domestic product, okay? Sewerage. You don't get it. Well, sewer, that's the stuff that comes out of your toilet. That's a gross domestic product. Sorry. What is it? It's the total value of final goods and services produced within the borders of the nation over the course of a year. That's what GDP is. The total value of final goods and services, meaning we don't include goods that are, I think I went over this with you earlier, right? We were talking about GDP, I think the first day. We don't include things that are going to be further processed or used to make something else. In other words, when the steel mill produces a ton of steel, we don't include that in our measurement of GDP because that steel is going to be used in making something else. So let's say they produce $1,000 worth of steel and they sell that to General Motors. And General Motors produces a $25,000 car, okay? We don't count the steel because the value of that steel is included in the value of the automobile as a finished good, okay? So this is called an intermediate good that's going to be used and processed and made into something else. We don't count those values. We only count the value of goods that are ready for consumption, ready to be sold, final goods and services, because those goods include intermediate goods value, okay? That when the farmer grows $100 worth of cereal and of grain and sells it to the cereal manufacturer and they produce $200 worth of cereal, we don't count the grain because that cereal includes the value of that grain, okay? So only final goods. So the GDP deflator looks at the total value of all final goods and services. That's what GDP is, sorry, not the deflator, okay? What does deflate mean? Shrink, okay? This is a measurement that allows us to shrink today's GDP, okay, by some rate of inflation. And what does that allow us to do? It allows us to compare total output today versus total output in an earlier time. Let's show you what I mean. If I produced this year, okay, or let's say last year, I produced one candy bar and I sold that candy bar for $1, all right? And then this year, I produced one candy bar and I sold that candy bar for $1.25. Now, if GDP is the final value the total value of all final goods and services produced within the borders of the nation over the course of the year, okay, if this is the only thing that my nation produces, did my GDP go up? Yeah, it went up from $1 to $1.25. But did I produce any more goods this year than I did the year before? Okay? No, I didn't. Okay? So if we say the economy last year, 2012, just for sake of example, was 12 trillion, 500 billion, 280, whatever, okay, and so on and so forth. All right. So, and this year, GDP is 13, 675, okay, whatever. Right? If I don't know what's happened to inflation between 2012 and 2013, can I say that our economy this year in terms of total output is bigger than it was that year if I don't know what the rate of inflation was? No, I can't. Okay? There's no way to know whether we are increasing really economic output or it's shrinking or staying the same unless we know how much prices went up. Here's an example. Okay? Let's say we'll use those same numbers. 2012, we produced $1,500 worth of goods, and 2013, 1,650. Okay? Do I know, without knowing the inflation, whether I really produced more goods and services here than I did that year? No. So what I have to do is first figure out what's the rate of inflation, and then reduce this value by that rate of inflation. In other words, if I know that all prices went up by 10%, what's the base index going to be this year for 2012? 100. And what's it going to be for this year? 110. Okay? Prices went up by 10%. So what that means is if I reduce this value by 10%, that will tell me whether that output is the same as that or greater or smaller. Okay? How can I do that? Well, I divide that value by the index and then multiply again by 100. Okay? So I would take the value. This is called nominal value, okay, without adjusting it for inflation. And we divide it by the index, our measurement of inflation, okay, and multiply by 100. And that gives us what's called real GDP in 2012 values. Okay? So we reduce today's GDP by the rate of inflation by dividing it by the index, and then we multiply by 100, and what do we get? We get 1,500, okay, in constant base year dollars. So in a real sense, if this was the case, our economy did not grow at all. All of that increase from 1,500 to 1,650 is just due to inflation. Okay? If this was, let's see, we'll make it 1,800. Okay? Now we can figure out whether the economy has really grown or not. Okay? Now it would be 1,800. Oops. Divided by 110. Can anybody do that one? Anybody got a calculator real quick? No? I suppose I could find one on here. Huh? 1636? Okay. So what this would tell us would be is that after we factor out inflation by reducing this value by the rate of inflation, okay, that in constant 2012 dollars, output increased from 1,500 to 1,636. So we did have real economic growth. We didn't have 1,800. Some of this increase is due to increases in prices, and some of this increase is due to increases in output. And the only way to figure out how much is due to increases in production is to remove the inflation component from it. So we divide this value by the rate of inflation by using the index, and that gives us real GDP. Okay? So we have a formula for determining real GDP in constant base year dollars. Okay? Real GDP is nominal GDP, face value GDP, divided by the index and multiplied by 100. Okay? All right? Now that's not coming up really until next chapter, but I thought it would be useful to introduce it now, okay? So we can understand what it is we're talking about here, the GDP deflator. The broadest measurement attempts to capture the changes in prices of all goods and services throughout the economy, okay? So it's the most useful economy-wide index of inflation, okay? We'll look at that a lot more in the next chapter.
So if the numbers are equal from this year and the year before,
After you reduce those prices by the rate of inflation, yeah.
so then we didn't have inflation, the prices just went up?
That would be inflation.
We didn't have increase, only the prices.
Yeah, only prices went up. In other words, if it was $1 this year and it's $1.25 next year, and this year's GDP is 1,000 and next year's is 1,250, right? Once we figure out, well, we have 25% inflation, so in a real sense, that's only 1,000 in terms of this year's dollars, okay? Constant base year dollars. Did the economy grow? No, it did not. All of that increase is just due to higher prices, all right? But, you know, I mean, if we're talking about a couple of things, 10 things, we can figure out, yeah, how many did we produce? Okay, we can go out and count them. But for the size of the U.S. economy, can we go out and count the number of things? No, we can't, okay? It doesn't make sense anyway, because some things we make more of, some things we make less of. Some things we used to make, we don't make anymore. And now we make some things that we never used to make. So we can't really go out and count things. The only way to determine whether the economy is growing or not is to look at the total value of what we produced between now and some earlier time, last month, 3 months ago, 6 months, last year, whatever, and reduce that amount by the rate of inflation. That allows us to determine, to factor out that increase in price, and that allows us to determine how much more in real output and real GDP we produced this year than we did last year, okay? What country has the largest GDP, do you know? India? That's a good guess. Not yet. China, not yet. It's going to be. Huh? No, Japan, we thought in the 70s, the rate Japan was growing, we thought Japan would have the largest economy by now, but that didn't happen. USA, number one. USA, still number one, okay? We used to be always the largest exporting nation too, but not anymore. China is now, right? China is now, and China's economy should overtake that of the United States in terms of size, right? Sometime in the next 10 years, maybe earlier, all right? They should have a larger economy, okay? And then India, if India keeps going, India will be number 2. The United States number 3, and then Japan number 4, okay? Huh? Japan might disappear. It might. Yes, that's right. That could be the case. Julio, question?
This is very similar to relative prices, right?
Yes, relative. It is. It is quite so. That's a very good connection. Absolutely. We don't care about absolute, except how they relate to other prices over the course of time. Right? Inflation. Yeah, for some. All right. Now, if I loaned you $1 today, okay, and a dollar will buy a candy bar, and I know that inflation is going to be 25%, okay? So how much is this candy bar going to be next year? $1.25. If you're going to pay me back next year, okay, what kind of interest rate do I have to charge you so that I can still buy that candy bar when you pay me back? 25%, okay? Because if you pay me less than $1.25 back, that $1.25 next year is worth less than the dollar I lent you today, because it won't buy a candy bar, okay? So next year, in order for me to still have the same amount of purchasing power that I lent you, when I get that money back, I have to charge you at least the rate of inflation to break even. If I charge you less than the rate of inflation, I lose, okay? I won't get enough money, I won't be able to buy that candy bar. When a bank lends you money, do they hope to break even next year? They want to make money, okay? So when the bank charges you an interest rate called the nominal interest rate, the rate that you pay for a loan, it has two pieces to it. First, they want to charge you at least the rate of inflation over the life of the loan, or what they expect the rate of inflation will be. That just breaks them even, okay? If I lend you $1 today and you pay me back $1.25 next year and everything has gone up by 25%, is that $1.25 worth any more than the dollar I lent you this year? No, it's not worth any more, okay? So the bank, in order to make a profit, I mean, in a real sense, did you pay any real interest? If you just pay the rate of inflation? No, you're just paying back in dollars that are worth less than what you borrowed. Yeah, so you have to pay more of them, okay? So when the bank loans you money, they're going to charge you the rate of interest. That is the rate of interest that's equal to their expectations about what inflation will be, and then they're going to add the real rate of interest over and above the rate of inflation as their profit, okay? That's their profit. So if the bank thinks inflation next year is going to be 8%, and they have to be competitive with their interest rates, okay? Otherwise, they won't be able to lend out money. Let's say they expect, they think they can make a 4% profit. They want to make a 4% profit. Then the interest rate they're charging you will be the sum of the two, 12%, okay? Which is equal to the expected rate of inflation plus the real rate of interest that you pay over and above the rate of inflation. Remember, the rate of inflation, if I just pay you the rate of inflation, then those dollars aren't worth any more in the future than the ones you lent me today in terms of what they can buy. Okay, so the real interest rate is 0. Okay? So the bank wants to add their profit to it. Now, what if the bank makes a mistake? Okay, and inflation turns out to be 9%. What happens to the real rate of interest that you pay? It drops to 3%. Okay, what if they make a big mistake? And rate of inflation turns out to be 12%. What's the real interest that you end up paying? 0. Okay? If the bank makes a mistake and inflation is higher than expected, who wins? You, borrowers. Okay? And who loses? The bank. Okay? So if inflation is higher than expected, people who have borrowed money come out ahead. They get to pay back less real interest. And the bank loses, creditors lose, because they earn less real interest, okay? Is inflation good for you? It depends. If your rent is fixed, right? You have to pay $1,000 a month rent, and you have a contract for the next 2 years, and inflation is 10%, 2 years from now, you'll be paying in a real sense 10% less. You win. Who loses? The landlord, the owner. Exactly right. Okay? So inflation, if you owe a lot of money, you want a lot of unexpected inflation. No, not necessarily, but you might. Usually we have one problem or the other, inflation or recession, okay? Meaning unemployment. Sometimes we get both. Okay? If you consider that this good here is a typical good, okay, all good. If demand is shifting out and prices are rising, the government can take action to kind of calm things down. Okay? If, on the other hand, manufacturing is decreasing its output, okay, that the supply curve is shifting in, so what's happening? Unemployment is rising. Less output means less jobs, all right? The government can take action to shift it out, okay? So the government can either calm down the economy by causing people to spend less money, keep prices under control, or it can take actions to increase output, cause supply to increase, and that way employment increases. Also, prices do tend to come down, right? But when we get this situation, okay, okay? Oops, sorry, I made a mistake earlier. It's very difficult because this is not only prices going up, but also output decreasing, okay? We've got two problems now: higher unemployment and higher prices. If the government tries to stimulate the economy to bring people back to work, that generally causes more inflation. But if they try to calm the economy down by reducing demand, that tends to cause more unemployment. So sometimes they have a dilemma. Do we want to have more inflation, or do we want to have higher unemployment? And I think I told you which one they usually go for. Yeah, no, inflation. They will try to reduce inflation at the expense of employment. Okay? But as that article I read to you last time said, that Bernanke has come to the conclusion, we don't need to worry about inflation when we're having this long, deep recession, right? So they'll concentrate on trying to create jobs. Okay? Let's see, what else I want to tell you about? Oh, Japan tends to have the highest savings rate, okay, in terms of the amount of money Japanese people save from their incomes. Tends to be one of the highest rates in the world, okay? I don't know today, but several years ago, okay, do you know how much you could earn on a savings account in Japan? .25% per year. What that means is if you put $100 in the bank today, and then next year, you'd have $100.25. Okay? Yes. All right? Now, why would people save at a very highest rate if the nominal interest rate that they're getting is only 0.25? Okay? Here's why. Okay? Remember, nominal is equal to the rate of inflation plus the real rate of interest. Japan was seeing deflation, okay, by minus, we'll say, 2.25%. Okay? So what's the real rate of interest that they were earning? Yeah, 2.5%, 2.5%. Okay? So it looks like they're only earning 0.25%, but after you factor in deflation, the real rate of interest for them was 2.5%. Okay, pretty decent. Okay. All right. That's part of it, yes. Interest rates are really low. Almost zero. Yes, indeed. They're very low, unless you get a Sears credit card. You see what they charge you? They're robbery. Macy's, Sears, yeah, 24%. When inflation is zero and interest rates are so low, for them to charge 24% is just criminal, okay? Just criminal. They should be arrested for that. That's just, that should be illegal to do something like that, okay? Yeah, you want to put this on your Sears credit card? Hell no. Are you kidding me? At those rates? Bandit. All right, let's see. I think that's pretty much it for, oh, no, there's something else. Recessions and depressions, we didn't talk about that. That's fairly obvious stuff, right? Talked about this, the economy expands, contracts, expands, and contracts, okay? As we're going to see when we get towards the end of the semester, one of the main reasons this happens is that business expectations about the future and our expectations or our intentions about the future don't match. Business thinks we're going to buy a whole mess of stuff, so they produce a whole mess of stuff, but we decide not to buy it all. What happens? They lay people off, the economy contracts. Business builds a whole mess of stuff, but we decide we're going to buy a whole lot more stuff. Then they have to increase output, and they hire people back, and the economy picks up, okay? That's primarily the reason why the economy contracts and expands, is that our expectations about the future, our intentions about the future in businesses don't match up. Now, there are shocks, okay, like this financial collapse, this calamity. It's amazing to me, frankly, that a lot of these people aren't in prison that caused this. They should be in jail, including a number of people who are unfortunately very close to Mr. Obama as his advisors. There's a number of movies out about this type of thing, and you really ought to take a look at them if you want to understand really what happened in the financial mess and what plunged us into the worst recession nearest to a depression since the 1930s because of these bankers. I hate bankers, hate them. Okay? Banks are a necessary evil, but unfortunately, they tend to be run by the most evil people on the planet. Okay? They are. They are. They are just whatever. At any rate, they should be in jail, most of these people. Okay? Who was it? Was it Merrill Lynch? Knew, in fact, that they were selling bogus investments. What Merrill Lynch, if you find out about stocks and that type of thing, you can agree to sell a stock in the future or buy it in the future, okay? And what they were doing is they were selling high, knowing that the value of the stock was going to fall, but they'd already placed a bet to be able to buy it in the future at a very, very low price. So they sold all of these investments to their customers, knowing that these were going to go down the tubes, and that the bank would make tons of money, but their customers would get screwed. Right? And they did it on purpose. They knew what was going to happen. Too much gambling going on, too. And meanwhile, they're making billions of dollars. Okay? So we go through expansions, peaks, and then depressions and troughs, recession, and then expansion, recession, okay, over the course of time. And what happens is we tend to get inflation, okay, when we're in these peaks, right? Too much demand, too many people making money, everybody's out there buying stuff, prices get forced up, and then things come crashing down, and then we worry about unemployment, okay?